Hey there, welcome back. So you've been digging deep into the world of electric vehicles, specifically NIO's place in the ever-evolving Chinese market. We've got a stack of your research right here, a mix of hard data, expert predictions, and even some eyebrow-raising rumors. Looks like you're trying to figure out if NIO is on the road to becoming the next Tesla, or if they're headed for a financial cliff.
It's a fascinating case, isn't it? We've got this company posting record sales numbers, yet they're burning through cash at an alarming rate. And then there's this whole takeover buzz, which really throws another wrench into the works.
Okay, let's unpack this. First, the good news. NIO's June sales were phenomenal, over 20,000 vehicles sold, a new monthly record for them. And if they hit their targets for the third quarter, we could be looking at a truly massive quarter for the company. But here's the catch. They also reported a loss of US $650 million in the second quarter alone. That puts them on track to lose over US $2 billion for the year. It's almost like they're sprinting towards success and a financial meltdown at the same time.
It's a classic dilemma for high-growth companies, especially in a market as dynamic as electric vehicles. They need to scale up quickly to capture market share, but that often comes at the cost of profitability. And one of your sources, the Electric Viking, raises some interesting points about how some EV companies, including NIO, might be using accounting tactics to paint a rosier picture of their financial health than reality suggests.
Hold on, you're saying the numbers might be a bit massaged?
Well, let's just say there's room for interpretation. For example, the Electric Viking source highlights the issue of carbon credit sales. These credits are generated when a company exceeds emissions reduction targets, and they can be sold to other companies who are struggling to meet their own targets. While it's a legitimate revenue stream, it can sometimes mask underlying profitability issues.
So you're saying these carbon credit sales might be inflating NIO's financial performance, making them look more profitable than they actually are. That's pretty important for someone trying to understand the company's long-term prospects.
Exactly. And the Electric Viking dives deeper into this, suggesting that if you strip away the revenue from carbon credit sales, NIO's losses might be even more significant than they appear. It's definitely something investors and analysts will be scrutinizing closely.
Okay, so maybe we need to pump the brakes a bit on the whole NIO is a runaway success narrative. But even with those potential financial red flags, we can't ignore their impressive sales growth, nearly 40% week over week in June. That's a serious upward trajectory.
Absolutely. And to fully grasp that growth, we need to zoom out and look at the overall Chinese EV market. This isn't just a story about NIO, it's about the incredible surge in demand for electric vehicles in China. Government subsidies are a big factor, as is the growing appetite for EVs among younger consumers. We're seeing a fundamental shift in the automotive landscape, and NIO is riding that wave.
So it's not just that NIO's doing well, it's that the entire EV market in China is booming. But that also means they're facing some serious competition, right?
Oh, absolutely. It's a crowded and fiercely competitive market. Think of it like a Formula E race, with everyone jostling for position at breakneck speed. We've got established players like BYD dominating the track with over 66,000 registrations in week 25 alone. Tesla, while facing some headwinds globally, is still a major force in China, pulling in around 17,000 registrations in that same week.
Wow. Those are some big numbers to compete with. And it's not just the big names, right? I know there are a bunch of other Chinese EV startups vying for a piece of the pie.
You're absolutely right. You've got companies like Xiaomi, XPeng, Leapmotor, and Zeekr, all nipping at NIO's heels. Xiaomi, known for their smartphones, is now making a serious push into EVs with sleek designs and competitive pricing. XPeng is focusing on cutting-edge technology, particularly in autonomous driving features. Leapmotor is targeting the mass market with affordable EVs. While Zeekr is positioning itself as a more premium brand, it's a real battle royale out there.
Okay, so NIO's got their work cut out for them. They're trying to scale up, navigate a complex financial situation, and fend off competition from all sides.
Exactly. And that brings us to a really interesting development. NIO's diversification strategy. They've recently launched two new brands, Firefly and Onvo, each targeting a different segment of the market. It's almost as if they're realizing that they can't just rely on one approach to win this race. They need to be more agile, more adaptable.
So tell me more about these new brands. What's the thinking behind them?
Well, Firefly is aiming for what's being called the boutique compact car market. It's a segment focused on smaller, high-quality vehicles that still offer a premium experience. Think of it as a more stylish and tech-savvy alternative to the typical compact car. Their first model is set to launch in the first half of 2025, with an expected price range between 13,000 and 36,000.
Interesting. So they're trying to capture that sweet spot between affordability and luxury.
Yeah.
What about Onvo? What's their game plan?
Onvo is going for a more mass-market approach. They're aiming for a wider customer base with vehicles that offer good value for money. Their first model, the L60 SUV, is priced around US $30,349, which puts them in direct competition with some of the more mainstream EV offerings in China.
Okay. So with these two new brands, Nia's essentially hedging their bets. They're trying to cover more ground, appeal to a wider range of customers, and maybe even create some internal competition to drive innovation.
It's a smart move in a market as dynamic and unpredictable as this one. But it also comes with its own set of challenges. Managing multiple brands effectively, each with its own identity and target audience, is a complex undertaking. It requires a delicate balance of resources, marketing strategies, and brand positioning.
Yeah, I can see how that could get tricky. You don't want to dilute your core brand or confuse customers.
Exactly. And then there's the whole question of whether these new brands will cannibalize sales from NIO's existing models. It's a delicate balancing act. And just when you think you've wrapped your head around NIO's strategy, we get hit with this bombshell, takeover rumors.
Right, this is where things get really juicy. We're talking about BYD, the current king of the Chinese EV market, potentially buying a controlling stake in NIO. Where did this even come from, and is there any truth to it?
Well, according to the Electric Viking, the rumor originated from a WeChat post by someone claiming to be a BYD employee. The post alleged that BYD was considering acquiring a 51% stake in a joint venture. That would effectively control NIO, although NIO would supposedly remain an independent brand. The proposed price tag was a cool RMB 16.5 billion. Now, whether this WeChat post is credible or just someone trying to stir the pot is up for debate.
Yeah, got to be careful about those internet rumors. But NIO's reaction to this whole thing has been pretty interesting. They're not just brushing it off as idle gossip. They're actually threatening legal action against the person who made the WeChat post. That seems like a pretty strong response,
It's okay.
especially for a company that's trying to project an image of stability and confidence.
It does make you wonder if they're trying to squash a rumor that might actually have some legs. Which then begs the question, why would BYD even consider buying NIO? What's in it for them? They're already the dominant force in the Chinese EV market. And they have their own premium brands. It's not like they desperately need NIO to succeed.
Yeah, it's a head-scratcher for sure. So let's put on our CEO hats for a moment. If we were calling the shots at BYD, what would we see as the potential benefits of bringing NIO into the fold?
Well, even though NIO is facing financial challenges, they do have some valuable assets, first and foremost. They've built a strong brand reputation, particularly among younger, tech-savvy consumers who are drawn to their stylish designs and innovative features. They've also invested heavily in their own technology, including their battery swap stations, which offer a unique and potentially game-changing approach to EV charging.
Yeah, those battery swap stations are pretty impressive. No more waiting around for hours at a charging station. You just pull in, swap out your depleted battery for a fully charged one, and you're back on the road in minutes. It's like a pit stop in Formula E, but for everyday drivers.
Exactly. And that's something BYD could leverage to enhance their own offerings. They could integrate NIO's battery swap technology into their own vehicles, giving them a competitive edge in terms of convenience and charging speed.
Okay, so access to NIO's technology and their brand reputation are potential pluses for BYD. But what about the downsides? I mean, we keep coming back to those massive losses NIO's racking up. Surely that has to be a major concern for BYD.
Absolutely. Taking on a company that's bleeding money like that is a huge risk. You're essentially inheriting their debt and their ongoing financial challenges. And there's always the risk that NIO's brand might lose some of its luster if it becomes associated with a more mainstream company like BYD.
And then there's the whole issue of merging two very different company cultures. I can only imagine the potential clashes between the two management teams. It's like trying to blend oil and water.
It's a valid concern. Merging two companies is never easy, especially when they have distinct identities and ways of doing things. There's always the potential for friction and resistance, which can derail even the most well-intentioned acquisitions.
So it seems like this potential takeover is a real gamble for BYD. There are potential upsides, but also some serious risks to consider.
Exactly, and that's what makes this whole situation so intriguing. It's a high-stakes game of chess, with each player trying to anticipate the other's moves and make the best strategic decision for their company.
All right, so we've covered a lot of ground here. We've looked at NIO's impressive sales growth, Their concerning financial situation, the fierce competition they're facing, their strategic move to diversify with new brands, and those tantalizing takeover rumors. I feel like we're starting to get a clearer picture of the complexities and challenges facing this ambitious EV maker.
We are indeed, and I think this sets the stage for a deeper dive into the factors that will ultimately determine NIO's fate.
Well said. We'll be right back to continue our exploration of NIO's journey and the future of the EV market. Stay with us. Welcome back. Before we dig deeper into those takeover rumors, I'd love to get your take on something the Electric Viking emphasized. They seem pretty skeptical about this whole BYD-NIO deal, calling it a potential financial albatross for BYD. What are your thoughts on that?
You know, it's easy to get caught up in the excitement of a potential merger, especially when you have two big players like BYD and NIO. But the Electric Viking brings up a crucial point. Mergers are about so much more than just flashy headlines and market share grabs. You've got to look at the underlying financials, the cultural fit, and the long-term strategic alignment. And frankly, on those fronts, this deal raises some serious red flags.
Let's talk about those red flags. What specifically makes you hesitant about this potential acquisition?
Well, first and foremost, there's the issue of NIO's financial stability or lack thereof, as we discussed earlier. They're burning through cash at an alarming rate. And while they have some promising technology and a growing customer base, there's no guarantee that they'll be able to turn things around and become profitable anytime soon. For BYD, taking on that level of financial risk is a big gamble. It could potentially drag down their own profitability and create a lot of uncertainty for their investors.
So from a purely financial perspective, it's a risky move for BYD. But aren't there other factors at play here? I mean, mergers and acquisitions are often driven by strategic considerations that go beyond just the balance sheet.
Absolutely. And that's where things get even more interesting. If we look at the broader EV landscape, both in China and globally, it's clear that the competition is heating up. We've got established automakers like Volkswagen, Toyota, and General Motors, all making aggressive moves into the EV space. And then there's Tesla, which, despite some recent challenges, is still the biggest name in the game. So for BYD, acquiring NIO could be seen as a way to consolidate their power, expand their reach, and fend off these growing competitive threats.
So look at defensive play. They're trying to shore up their position and create a stronger barrier against these new entrants.
Exactly. And by bringing NIO under their umbrella, they could potentially leverage NIO's brand appeal technology and existing customer base to create a more formidable force in the market.
Okay, I see the logic there. But let's play devil's advocate for a moment. What if this whole takeover talk is just a smokescreen? What if NIO is actually using these rumors to their advantage, maybe to attract more investors or boost their valuation?
That's certainly a possibility. In the world of high finance, perception is often as important as reality. And for a company like NIO, which is trying to establish itself as a major player in the EV market, creating buzz and generating headlines can be a powerful way to attract attention and potentially even inflate their stock price.
So it's a bit of a poker game. Everyone's trying to read each other's tells and make the best move based on incomplete information.
Exactly. And the stakes are incredibly high. The EV market is evolving so rapidly that it's hard to predict who will emerge as the ultimate winners. And just when you think you've got things figured out, something unexpected happens, like these takeover rumors, that throws everything into question.
It's enough to make your head spin. But let's shift gears for a moment and focus on something a bit more tangible. NIO's core business. They're pushing hard to grow sales. But at what cost? We keep circling back to those massive losses. Is this a sustainable path for them?
That's the million-dollar question, isn't it? Can they achieve profitability before they run out of cash? Or will they continue to hemorrhage money until they're forced to either sell out or go under?
I mean, US $2 billion in losses is a staggering amount. How much longer can they keep that up?
Well, they've raised a significant amount of capital through various funding rounds and investments, and the Chinese government has been very supportive of the EV industry, providing subsidies and incentives to help companies like NIO get off the ground. But at some point, they'll need to show investors a clear path to profitability. Otherwise, the money will dry up, and they'll be in real trouble.
Sounds like they're walking a tightrope. They need to grow aggressively to compete with the big players. But they also need to be mindful of their bottom line and make sure they're not burning through cash at an unsustainable rate.
Precisely. It's a delicate balancing act. And it's not unique to NIO. Many high-growth companies, especially in tech-driven industries, face the same challenge. They need to invest heavily in research and development, marketing, and expansion, all while trying to keep their costs under control.
And in NIO's case, They're doing all of this in the context of one of the most competitive and rapidly evolving markets in the world. It's like trying to build a spaceship while it's already in orbit.
That's a great analogy, and it highlights the incredible pressure these companies are under to constantly innovate, adapt, and stay ahead of the curve.
Speaking of innovation, let's talk about those new brands Neo has launched.
Huh.
Firefly and Onvo. It seems like a smart move to try and capture a wider range of customers. But it also adds another layer of complexity to their already challenging situation.
Yeah.
How do you see these new brands playing out in the market?
Well, I think it's a bold move, and potentially a very smart one. By creating these distinct sub-brands, Neo is essentially hedging their bets. They're acknowledging that they can't just rely on one approach to win. In this increasingly diverse EV market,
So it's like diversifying their portfolio. They're spreading their risk and trying to appeal to a wider range of tastes and budgets.
exactly. Firefly, with its focus on the boutique compact car market, is targeting a more discerning customer who is willing to pay a premium for style quality and a unique driving experience. On the other hand, Onvo is going after a more mainstream audience with a focus on affordability and value.
Okay, so they're trying to cover both ends of the spectrum. But isn't there a risk that these new brands will dilute the Neo brand? I mean, if they start offering more affordable EVs, won't that undermine their premium image?
That's a valid concern. Brand management is crucial in the automotive industry, especially in the luxury segment. Neo has built a strong reputation for quality innovation and exclusivity. And if they're not careful, these new brands could tarnish that image and confuse customers.
So how can they avoid that trap? How can they successfully manage multiple brands without compromising their core values and their brand identity?
It's a delicate balancing act, and it requires a very clear and strategic approach to brand positioning. Each brand needs to have its own unique identity, its own target audience, and its own story to tell. And they need to be marketed and distributed in a way that doesn't create confusion or overlap.
It sounds like a logistical and marketing nightmare.
Yeah.
But if they can pull it off, it could be a game changer for them.
Absolutely. Successfully managing multiple brands could give them a significant competitive advantage, allowing them to reach a wider audience, generate more sales, and ultimately, hopefully achieve profitability.
Okay, so we've got this intriguing multi-brand strategy playing out. We've got those persistent takeover rumors swirling around, and we've got this underlying question of whether Neo can navigate the choppy waters of hypergrowth and intense competition to become a truly sustainable and profitable company.
It's a complex and multifaceted story, and we're only just scratching the surface.
Well said. We'll be back in a moment to continue our exploration of Neo's journey and what it all means for the future of the EV market. Hi, we're back. We've been dissecting Neo's journey, their ups and downs, the competition, even the whispers of a BYD takeover. It's clear they're not just building cars. They're navigating a high-stakes game with global implications.
It's a great point. What's happening with Neo right now isn't just a company story. It's a microcosm of the entire EV market's evolution. The choices they make, the challenges they overcome, they're all lessons for anyone trying to understand where this industry is headed.
Okay, so let's zoom out a bit. Based on what we've learned about Neo, what bigger lessons can we draw about the EV market as a whole?
Well, one thing is clear. Building a successful EV company is incredibly difficult. It's capital-intensive, technology-driven, and the competition is fierce. It's not enough to just have a cool car and some flashy tech. You need a rock-solid business plan, a team that can execute, and a deep understanding of the market.
Yeah, Neo's financial struggles, those billion-dollar losses, are a sobering reminder that even a company with a great product and growing sales can still falter. It's not just about hype. It's about sustainable growth and eventually turning a profit.
Right. And this brings us to another key lesson, the importance of diversification. Neo's move to launch those sub-brands, Firefly and Onvo, shows they're recognizing the need to appeal to a wider range of consumers. They can't just focus on one segment of the market. They need to have offerings that cater to different needs and price points.
It makes sense. If you want to compete with the big dogs like BYD and Tesla, you can't just put all your eggs in one basket. You need a portfolio of vehicles that captures different slices of the market. But as we discussed earlier, managing multiple brands is tricky. It's a delicate balancing act.
Absolutely. Neo needs to ensure that Firefly and Onvo complement their core brand. Without cannibalizing sales or diluting their premium image, it's a challenge many companies face when they diversify. How do you expand without losing sight of what made you successful in the first place?
It's like walking a tightrope. You're trying to reach new heights. But one wrong step could send you tumbling down.
Exactly. And all of this is happening against the backdrop of an industry that's in constant flux. The technology is evolving rapidly, consumer preferences are shifting, and government regulations are playing a huge role in shaping the market.
It's a dynamic environment,
Oh.
to say the least. So with all that in mind, let's circle back to those takeover rumors. If BYD were to acquire NIO, what ripple effects could we see in the EV landscape?
Well, it would certainly shake things up. On the one hand, it would consolidate the market, giving BYD even greater influence and potentially accelerating the pace of innovation. They could leverage NIO's technology and brand appeal to create a truly formidable force in the global EV market.
But on the other hand, wouldn't that also stifle competition if one company becomes too dominant? Wouldn't that limit consumer choice and potentially slow down progress?
That's always a concern with mergers and acquisitions, especially in a relatively young industry like electric vehicles. Regulators will be watching this closely to ensure fair competition and prevent any one company from gaining a monopoly.
Okay, so lots of potential outcomes, lots of uncertainty. It's a real nail-biter. But here's what I keep coming back to. NIO's success, or lack thereof, hinges on their ability to innovate and adapt. It's not just about making great cars. It's about staying ahead of the curve, anticipating market trends, and constantly evolving their business model.
I completely agree. And that brings us to the most crucial question for any company, but especially one in a fast-paced industry like this. Can they create a culture of innovation that permeates every level of the organization? Can they empower their employees to think creatively, to challenge assumptions, and to constantly push the boundaries of what's possible?
It's not just about having a brilliant CEO or a team of talented engineers. It's about creating an environment where everyone feels empowered to contribute new ideas and drive change.
Precisely. And that's something that can't be easily replicated or acquired. It has to come from within, from a deep-seated belief in the power of innovation to transform not just a company, but an entire industry.
So as we wrap up this deep dive, I want to leave our listener with a final thought. We've analyzed the data, dissected the strategies, and explored the potential outcomes. But ultimately, NIO's future, like the future of the entire EV market, is still being written. And the most exciting part is that we're all along for the ride.
It's a thrilling time to be witnessing this transformation, to see how these companies are pushing the boundaries of technology and redefining what's possible in the world of transportation.
Well said. A huge thanks to you, our expert, for guiding us through this fascinating exploration.
It's been my pleasure.
And to you, our listener, thank you for joining us on this journey. We hope you've gained some valuable insights and that you'll continue to explore the ever-evolving world of electric vehicles. Until next time.